Yes, so April 2023, question 5B, it reads, Dex Limited manufactures a single product branded XV. The company operates a standard marginal costing system. And then you're told the following information for the month of March 2023 is available to you. So number one, you're told the budgeted production and sales for the month amounted to 6,000 units. Number two, you're told the standard selling price of a product XV per unit is 13,200. Number three, you're told the variable standard manufacturing cost per unit is as follows. So we have the material, and which is that is direct material cost 42.25. And actually, we are told to produce 1 unit of this product, then the company requires 2.5 kgs of this material at shillings 16.90 per kg. So that is basically the standard quantity per unit of material and also the standard price of material. Then you have labor, which is 23.50, and you're given the standard hours per unit 1.25, and then the standard rate, which is 18.80 per hour. And then you have the variable production overhead, which is 16.75, and this you can see it is absorbed based on the direct labor hours, because you're told is 1.25 direct labor hours at shillings 13.40 per hour. And then you're told the actual results for the month of March 2023 are as follows. So now what you're given here is the actual data. So first of all, we have the production, which is now the actual production, which is the 63.8 units. And then we have the actual sales, which was 81,075. And remember, these figures now are in thousands of shillings. And also there we're given the actual quantity which was sold for this product. We have the direct material purchased and used, 1473 kgs at a cost of 27,987,000. We have the direct labor cost 363, and you're given the actual hours there. We have the actual variable production of height. And then number 5, we are told the variable production of height are absorbed on the basis of the direct labor hours. Number 6, you're told the opening and closing inventory of finished goods are valued at the standard variable manufacturing cost per unit. So what are we required to do here? We're required to compute a number of variances. One, we're required to compute something called the sales price variance. Number 2, we are required to compute the sales volume contribution variance, direct material price variance, direct material usage variance, direct labor rate variance, and then direct labor efficiency variance. So these are questions on variances. Remember, you said this is an area which has very, very high chances of being tested this sitting. So let's start with the first variance there. That is the sales price variance, the sales price variance. And remember what we said is that as far as these particular variances are concerned, what is very, very important for you to be able to remember is the formula. Because if you don't have the formula, then you can't be able to compute these variances. Remember also what we said is that in management accounting, and also I think in FM, formulas are always marked. That's what we said. In FM, in MA, formulas do have some marks. So therefore, you must remember the formula. So if you can be able to recall to compute this one, the sales price variance, we said we take what? The standard selling price minus the actual selling price minus the actual selling price, and then you multiply that with the actual what? The actual quantity sold. That is basically the formula for computing this. So what we need to do is basically to have all these items here. So all these particular figures here. So from the question which we are given here there, I think maybe first of all we can have the standard selling price. And the standard selling price is basically at paragraph 2, where we are told the following information for the month of March is available. So we are given the budgeted production and sales for the month, which was 6,000 units. And then we also have the standard selling price of this product. So remember here we are dealing with the with the sales of the finished product, the sales of the finished product, because once the company subjects these particular materials to the production process, then the company produces a finished some finished product, which you're told is branded as XV. So here we are concerned with the selling price of this product, the finished product. So therefore, the standard selling price as per note number 2, we are told is shillings 13,200. So this one we already have it, and then we need now to go to where we have the actual data. We pick these two values here, the actual selling price, so and also the actual quantity which was sold. So that is information. We have it in note number 4. In note number 4, we are given what? We are given what's there? We are given the sales. I want us to go to where we have the sales. And the sales, first of all, we are given the actual quantity which was sold, which was 56 what? 5640. This is the actual quantities or the actual quantity sold, or the actual units which were sold. And then we also need to determine the actual selling price. Are we given the actual selling price? No, but we can be able to compute that because we have the actual sales in shillings, and also we have the actual quantity. So therefore, for us to get the actual selling price, we need to take the actual sales in shillings, we divide that with the actual quantity sold. So therefore, this one will be equal to the actual sales, which is 81,075, and I hope you can see those figures are in thousands of shillings. We divide that with the actual quantity, which is 5640. So this will give us the actual selling price per per unit. The actual selling price per unit. So the actual selling price per unit here will be how much? Will be how much? I'm told is the shillings 14,375 shillings per unit. So that is the actual selling price. So therefore, we can proceed and we compute this sales price variance by taking the standard selling price, which is this one, shillings 13,200 minus the actual selling price, which is this one, 14,375. We multiply that with the actual quantity sold, 56 what? 40. So therefore, let's get this variance. First of all, you take this minus this, and I hope you can see this minus this is a negative. Is a negative. If you say we get a negative automatically, it means that our variance by the end of the day will be adverse. Will be an adverse variance. Adverse variance. So how much will be our variance here? So the variance I'm told is 627,000. So that should be 6,620 what? 627. So that is our variance, and in this case, I'm saying is adverse. So remember, you say this variance. Whenever you're given the variance, if you just leave it like that, you have not indicated whether it is favorable or advanced, you may not get a mark for that. So therefore, we said in terms of how these will be marked, the formula will be having a mark and the answer. The formula and the answer. 1 mark there, 1 mark there. So the formula is very, very important. So let's move to the other variance, number 2. The other variance, and that is the sales volume. Sales volume contribution variance. So how do we compute this one? How do we compute this one? So remember what we said that here there is a question which we did, and the question specifically was requiring us we compute the sales profit, the sales profit, that is the sales volume profit variance. So we said here this depends with the system, the costing system which is used by the company. If the company is using marginal costing, and that's actually what you're told, then you'll be required to compute something called what? The sales volume contribution what? Variance. But if the company is using absorption costing, we will be required to compute something called what? The sales volume profit what? Variance. So how do we compute this one? We say to compute this one, we take the standard contribution. the standard contribution per unit, of which now we know how to compute the contribution, and then we multiply that with the budgeted quantity, and then we less what? The actual quantity. The actual quantity, that is the actual quantity sold. That is basically how we get this one. So in our case, remember, we already have the actual quantity sold here. And then we also have the budgeted quantity. So if we go to the information, we have, I think at the paragraph 1, additional information about your told the budgeted production and sales was 6,000. So the company had budgeted it will produce and sell how many units? 6,000. So we already have this one, the budgeted quantity. So what we need to compute is this one, the standard contribution per unit. So if we to compute this one, we will take, that is to compute the standard contribution per unit. So remember here when we talk about the contribution, we are referring to the contribution margin. So here we take the standard selling price per unit, minus the standard variable cost per what? Per unit. Standard variable cost per what? Per unit. That is how we compute the contribution. So we already have the standard selling price. What we have here, standard selling price 13,200, and then we less the standard variable cost. The standard variable cost, we have that information at the paragraph number, in additional information number 3. In note number 3, we are told the variable standard manufacturing cost per unit are as follows. So we are given the variable or the standard variable manufacturing cost per unit. So what we need to do is basically we add all those figures. Direct material cost, the standard direct material cost, standard direct labor cost, and the standard production of it. We add those figures. We will have 42.25 plus 23.50 plus 16.75. So that now will give us the standard variable cost per unit. So we less all this from this figure here, which now will give us the standard contribution per unit. The standard contribution per unit. So that will give us what? That will give us what? That will give us a final figure of what? What are you getting here? I'm given a figure for how much here? Yes, I'm given a figure for shillings 49.50, which is basically per unit. So that is now the standard contribution. Contribution, remember I've said, refers to the contribution margin. So therefore, we can compute this variance. So we take this, which is the 49.50. We multiply that with the budgeted quantity. So in this case, the company had budgeted, as per the information we have in note number 1, the company had budgeted it was to produce and sell 6,000. But how many units were sold? And in this case, if you go to note number 4, you can see we are given the actual units now which were produced, and also we are given the actual units which were sold. What do we use here? We use the actual units which were sold, not the actual units which were produced, the actual units which were sold. And that is 56 what? 40. 56.40. So first of all, get the difference between these. And actually, you can see also that is a negative. Is it a negative or a positive? It's basically a positive. It is what? It is a positive here. It is a positive. So I'm given that this will be what? That will give us what? That will give us that figure here. Yes, and I hope we have not interchanged those items here. That should be the correct thing. That should be the correct thing here. I hope we have not interchanged the budgeted and the actual. Have you interchanged? No, this one should be budgeted. Budgeted what? Budgeted quantity and the actual quantity. Budgeted and the actual quantity. It basically means that the company sold less units than it had budgeted. So will this variance be adverse or favorable? Whatever we have computed here, is this adverse or favorable? Yes, I think this one should be adverse, because generally what you do here, you basically compare now what the company sold. The company had budgeted, it was to sell 6,000, but you can see the company sold less. If you sell less than what you had budgeted for, that variance is automatically adverse. Is automatically what? Adverse. Sasa is out of adverse here. Is adverse. Sasa, yes, it is adverse. It is adverse. It is adverse. It is adverse. Okay, so let's move to the other one. That is the Roman 3. So in Roman 3, what are we required to do? We are required to compute the direct material. Direct material price variance. So this is what is abbreviated as MPV. MPV, the material price variance. So here now we are dealing now with the materials. Remember here we were dealing now for the two variances. Variance number 1 and number 2, these were variances in relation to the finished product. So here we are dealing with the material. So how do we compute this one? Price. So that is what is important. We take the standard price of materials minus the actual what? Actual price. And then you multiply that with what? Actual quantity. Actual quantity. And remember in this case here, we are talking of the materials. Actual quantity of material which were used. So let's have these all these items which are required. So for the standard, because we need to have the items here, we need to have the standard price, the actual price, and the actual quantity of the materials which were used. So the standard price, automatically that one we have it in number 3. We are given the standard price of materials, which was 1690 per kg. 1690 per kg. And then we have the actual data, you go to number 4. Specifically go to the materials. So for the materials, you're given the actual quantity, which was purchased and used. That is 14,730. And then we don't have the actual price, but the actual price is something we can be able to compute. We are going to take the amount spent in buying materials, 27,987,000. We divide that with the actual quantity. 14,730. 14,730, which will give us the actual price. Actual price here. So what will be the actual price? The actual price in this case will be shillings, 1900 per kg. So therefore, let's compute the material price variance. And this will be equal to the standard price, 1690, minus the actual price, 1900, multiplied by that with the actual quantity, 14,730. So equally this minus that is the first thing you need to work out. That will give us a negative. The company paid more money when buying materials than what was budgeted, to be paid. So this will be shillings 83, 300, which is basically what? Which is adverse. So let's move to the other variance, number 4. Number 4. where we are required to compute the direct material usage variance. This is what abbreviated as MUV, direct material usage variance. So how do we compute this one? So this is equal to the standard price, multiply that with the standard quantity minus actual quantity. Yes, so that is basically how we compute this one. So in our case, we already have the standard price here. We have the actual quantity here. So what you're not given is this one. And actually, we say this is something which the examiner will not have given you. So we say to compute the standard quantity, we take the actual what? We take the standard quantity per unit. The standard quantity per unit. So how many kgs of this material are required to produce one unit of the finished product, which is XV? And then we said we always multiply that with the actual production. The actual units which were produced, the actual production. So first of all, we already have this in note number 3. In note number 3, we are told that to produce 1 unit of this finished product, that is XV, the company requires 2.5 kgs. So this is a standard quantity per unit. So we have to multiply that with the actual production. So how many units of the finished product were produced? We have that information in note number 4. The actual units of XV which were produced was 6380. So this is how we compute what? The standard quantity, because we said that is something which the examiner will not have given you. That is how we compute it. So this will give us what? The standard quantity, 2.5 times 6380 times 6380, the standard quantity. The standard quantity is 15,950 kgs. Okay, so having that, we can compute the material usage variance, which will be equal to the standard price, which we have up there, 1690, multiplied that with the standard quantity, 15,950, minus actual quantity. Actual quantity, we have it here, 14,730. So, and then first of all, work out that, which basically will give us a positive, and then we multiply that with 1690, and we get the material usage variance. So I'm given 2061. That is 2061, 800. And this is favorable or adverse. In this case, the company had budgeted to use these materials, but basically the company used less materials. So this is basically favorable. This is a favorable variance. Okay, so let's move to the other variance there. And that is the 𝗓𝗊 rate. 𝗓𝗊 rate variance. 𝗓𝗊 rate variance. 𝗓𝗊 rate variance. So basically, we say the 𝗓𝗊 rate variance. This is equivalent. It is equivalent to this one. It is equivalent to the material price variance. It is equivalent to the material price variance. So the formula which we use is just the same, only that here we don't deal with the price. We deal with the rate here. So you take the standard rate minus actual rate. Equally here, we don't deal with quantity. We deal with hours. So in case of 𝗓𝗊, so we take this one is equal to the standard rate minus actual rate, multiply that with the actual, hours. And actually, we said this should be actual hours which were paid. So we said in case there was a difference between the actual hours which were paid and worked, then automatically we said that is an idle time. Idle time. And in such a case, we said you have to compute something called the idle time variance. So where do we have the standard rate? Standard rate, automatically we have this in note number 3. So we go to where we have the labor. So we are told the standard rate per hour is 1880 per hour. Then the actual rate, the actual hours, we get this from the information we have in note number 4, where we have the actual data, the actual data. So for labor, we are given the actual hours, which were 8535 hours. So we don't have the actual rate, but that is something we can be able to compute by taking the actual direct labor cost, which is 15,636, and these figures are in thousand. We divide that with the actual hours, 8535. This will give us the actual rate, the actual rate per hour, the actual rate per hour. The actual rate per hour here is how much? Actual rate, I'm told is 1800. So therefore, our labor rate variance will be equal to the standard rate, which is 1880, minus actual rate 1800, multiplied by the actual hours. The actual hours are 8535. First of all, you work out that. You can see that is basically a positive, meaning that by the end of the day, this would be a variable. This would be a favorable variance. Favorable variance of what? Of 6828 100, meaning that is 682 800, which is basically what? Which is favorable. Okay, so finally we are required to compute the direct labor efficiency variance. This is what is abbreviated as LEV, the labor efficiency variance. And actually, we said that this one is equivalent to material usage variance. So the formula is just the same here, only that we replace quantity with hours, we replace the price with the rate. So we take the standard rate, we multiply that with the standard hours minus the actual hours. So in our case, we already have this one, the actual hours. We have the standard rate here. So what is missing are the standard hours. Just like what you have computed the standard quantity, the standard hours are equal to the standard hours per unit times what? Times actual production. Production. So therefore, let's go to the information we have in note number 3. In note number 3, we are given the standard hours per unit, which are 1.25 hours per unit times the actual production. The actual production, we have that in note number 4, 6380. So this will give us the standard hours. That will give us the standard hours. Standard hours. Standard hours here. I'm given what? 79.75 hours. Okay. So we proceed and compute these variance. Now we take the standard rate, which is there, 1880, multiply that with the standard hours, what we have computed here, 7975, minus the actual hours, 8535. Yes, and then we get now our variance here. We get our variance. So first of all, get the difference, which is basically a negative, and then we multiply that with the standard rate, which will give us what? 1052, 800, which is what? Is it adverse or favorable? Adverse or favorable? Adverse or favorable? Yes, that is adverse. Yes, so basically that is it, that what was required as far as that question is concerned, a computation of what? Of variances. So what you need to do, try to master on this. Basically, I feel that this is an area which has very high chances of being tested. But equally, also make sure you revise on all the other fractional budgets, because we said the preparation of the other fractional budgets, like maybe the sales budget, the production budget, the material usage budget. So we said not much challenge as far as the preparation of those other functional budgets are concerned. Because what I want us to just revise today is on preparation of the cash budget. So equally what I was saying is that revise on the other variances, not other budgets, other variances, because here we have not computed issues to do in the overhead variances, like what? Like the variable overhead variances. We talked about a number of them, and also we talked about the fixed overhead variances. Make sure you revise on all of them. And then finally, I think we can revise on a question on cash budgets. There is a question which I want us to do here. I think from the sitting of December 2021. I don't know whether we did, but I think we only did one question for cash budget. I just revise this one, which is the question number 4. Question number 4. Take out this particular question here. Yes, are you there? Do you have the question with you? The question for this question for cash budget? Okay, so if you're there, we can go through it. We see what we are told. And the question reads, so basically we start with part A. Make sure you check on part A, what are the benefits of a budget. So make sure you check on those theories. So, but in part B, we are told that you are in charge of making forecast and preparing budget for 𝗂𝐏𝐀 Limited. You have been supplied with the following costs and revenue forecast for forecast and details of payment. So we are given the forecast for revenue and cost for half year, which ended at 2022. So we have information for January, Feb, March, April, May, and June. We have the direct material purchases. We have wages. We have overheads, which include production, administrative, selling, and distribution. And then we also have the sales. Remember, these are budgeted or the forecast. And then we have additional information number 1 up to note number 8. So what are we required to do? In this case, we're required to prepare the cash budget for the month of April 2022 to June 2022. So we're required to prepare cash budget of this company, and basically for how many months? April, May, and June. April, May, and June. 3 months. So this is the cash budget of this particular company here. And remember, we are preparing that for April, May, and June. How many months? 3 months here. 3 months. So, and the figures which are given here, I hope you can see they are in thousands of shillings. They are in thousands of shillings. So we equally need to indicate that all our figures will be in thousands of shillings. Will be in thousands of shillings like this. And the first thing which we start with here is by recording the opening cash balance, basically for the first month. And then from there, we record the receipt, the money to be received. And then from there, we record what? The expected payments. So therefore, here what we start with, remember these are the details now. We always start with the opening cash balance. And then we add the receipts, the money which is expected to be received by our company here. And the receipt, expected receipt. And then down here, we will come and get the total receipts. And then we take into account what? The payment. What basically the company expects to do what? Expect to pay. Okay. So let's record this information here. And we said when preparing you come across a question for cash budget, we said it's always advisable to record these items concurrently. So if you come across a receipt, just come and record it there. If you're given information about payment, record it there. No need of, first of all, you say you record all the receipt, and then later on you deal with the payment. No need of doing that, because that will consume a lot of your time. So where do we have the opening cash balance? So in note number 1, we are told the cash balance on 1st of April 2022 was expected to be 90 million. So the opening cash balance in this month was expected to be 90 million, but remember our figures are in thousands of shillings. So automatically that would be 90,000. And then from there, we record now the information about what? The receipt, the information about payment. It is always advisable, because we have the information which we have at the paragraph 1. First of all, deal with whatever you're given in the additional information. In the additional information number 2, we are told a period of credit allowed by suppliers average 2 months. What does that mean? It basically means that the suppliers to this company, automatically these are suppliers of materials, because you can see these companies buying some raw materials. So the suppliers of materials give the company a credit period of 2 months. 2 months, meaning that anytime the company make purchases of raw materials, they will be paid after 2 months. For example, the ones which were bought in April, they will be paid in which month? They will be paid in the month of June. In the month of what? In the month of June, after 2 months. So that is month of April and May. They will be paid in the 3rd month now. Okay. So, okay, before we deal with that, maybe we will automatically have to check whether maybe there was some, or the purchases, all of them were on credit, or basically there were some which were in cash before we deal with that. So let's first of all, we go to the other item, number 3, and your total debentures worth 125 million are expected to be issued in May 2022, and the amount will be received on the same month. So in this case, we are told the company expect to issue some debentures. So automatically, once the company issue debentures, the company will receive money, because debentures, these are debt instruments issued by the company to raise money. So the company will issue debentures here, and the debentures are expected to be issued in which month? In the month of May, amounting to 21 million, 125 million, and you're told the amount will be received in the same month. In the same what? Month. This is the money to be received from the issue of debentures. Number 4, we are told a new machine will be installed in the month of March. In the month of March, a month before April, at a cost of 150 million, and the payment is expected to be made in May. So the company expect to install, or in other terms, to buy a machine. So the machine will be installed in March, but when will the payment be made? That is our interest. The payment will be made in the month of May. The cost of the machine is 150 million. That is when the payment will be made, in the month of what? In the month of May. And then note number 5, we are told that a sales commission of 3% is payable after 1 month of sales. So there will be a sales commission, but we will have to compute that. Sales commission. And we are told this sales commission is 3%, which is paid after 1 month of sales, 1 month of sales. So I think we can compute this sales commission. And in our case here, remember now we're interested with the commission which was paid in April, May, and June. And take into account this commission is paid after 1 month. So automatically we need to have the sales. Okay, so we need to have the sales for March, the sales for April. Is that the case? Yes. So the sales for March, April, and May. So let's have the sales so that we can compute the commission. So commission, or yes, I think that's what we have recorded here. Rincon debentures. It will record 125,000. I think this is what you have recorded here. 125 million. 125 million. But remember, all our figures are in thousands of shillings. We record it as 125,000. Hope that is correct. Or what is the problem? Okay, sawa. Okay, so I want us to compute now the commission, but in this case, I'm saying we must have the sales for March, April, and May. So the sales here, as per the information we have at the paragraph 1, the sales for March, this one is for 40,000. For April, there is 50,000, and this one, 360. So in this case, we don't need to have the sales for June, and then we compute now the sales commission. The sales commission, which now, as per note number 5, we are told will be 3%. 3%, of which you are told this will be paid after 1 month. For example, the sales commission for this month here will be paid in April. So what would be 3% of this? 3% of 440. 3%, 3% of 440,000. That will give us 132,000. That is the sales commission. And I think that should be 13,200. 13,200. It can't be 132,000. Yes, 13,200. And then 3% of this, which will be paid in May, 10,500. And then 3% of the sales of May, which will be paid in June. Yes, so in our case here, we have the sales commission. So we record the sales commission for which will be paid in April, 13,200, which will be paid in May, 10,500, and which will be paid here is what? Is 10,800. So that is a commission basically to be paid by our company here. So we are done with that point now. Let's move to the other point there. Where we are told a dividend of 100 million is expected to be paid in June. That is still a payment. A payment for what? A payment for dividends. So the dividends we are told of 100 million will be paid in which month? Will be paid in June. No problem with that. Number 7, you are told there is delay in 1 month in the payment of overheads and wages. Overheads and wages, basically we are told, will be paid after 1 month. So I think we can basically deal with that. Let's go back up there where we have the overheads. First of all, we start with the production overheads. Production overheads, which we are told there is a delay in 1 month. So the overheads which will be paid in April are automatically the overhead for March. So the overheads for March were how much? That is production overheads for March were 40,000. So those are the ones which will be paid for in April. And then the ones to be paid in May are for April, which were 45,000. And the ones to be paid in June are for May. For May, they were 36,000. Okay, so we are done with that one. So then still, we also have wages. Where do we have wages? Because you're told overheads and wages. Yes, and I think first of all, these will apply to all overheads. Because you can see overheads, we have a number of them: production, administrative, selling, and distribution. We consider all of them, not only production. So let's deal with the administrative overheads, which equally will be paid after 1 month. So the ones which will be paid here in April are for March, which is 47,000. The ones to be paid in May are for April. April were 24,000. What? What have I taken here? This for March, the administrative overheads for March were 27,000. 27,000. The ones to be paid in May. Will be for April, 24,000. The ones to be paid in June are for May, 25,000. And then still we have the selling and the distribution. The selling and distribution of heads. The ones to be paid here are for March, 18,000. The ones to be paid here are for April, 13,000. The ones to be paid here are for May, that is 11,000, like that. And then this also applies to wages. Wages is below the direct material. So we have wages. So wages equal will be paid after 1 month. There is a delay in 1 month. So the ones to be paid in April are for March, which basically is 100,000. The ones to be paid in May are for April, 90,000. Okay. Yes, 90, not 92, rather 72,000. The ones to be paid in June are for May. Are for May, 54,000 like that. Okay. So then from there, we go to note number 8. We are told 20% of the debtors pay cash. And then you're told pay cash, receiving a cash discount of 4%. And then you're told 70% of the debtors pay within 1 month and receive 2.5% discount, while the remaining debtors pay after 2 months without any discount. So I think first of all here, what we need to do is basically to do what? To compute the amount to be received from debtors. I think first of all, we can deal with the cash sales. Those will pay in cash. So because we can refer to that as cash sales. And then from there, we proceed and we compute the receipt from debtors. The receipt from debtors, this will include the amount to be received from debtors who do not pay in cash. So let's first of all, we compute the debtors who pay in cash, which we can refer to as the cash sales. The cash sales. So if you're interested with the amount received in April, May, and what? And June. So first of all, we take the sales. We must have the sales here. The sales which were made in April, 350,000. In May, 360,000, and in June, 60,000. So in this case, we are told that the debtors who pay in cash are 20%. So those who pay in cash will be 20%. So can we get 20% of this? 20% of this will be what? Will be 70. 20% of this will be what? 72,000, and 20% of that will be what? Will be 72. But in this case, they will not pay this particular amount because they are given a cash discount. For paying in cash, they are given a discount of what? They are given a cash discount of 4%. So they will not pay this amount, but what the amount which they will pay, now the actual cash to be received will be what? After the discount. The discount in this case, we are told, is 4%. So the amount they will pay will be equivalent to 96% after deducting discount of 4%. Sasa? Yes. So let's just compute that directly here. We get 96% of this. 96% of 70,000. 67,200. This one I'm given 69,120. 69,120, like that. Okay, so that is now like the sales made in cash. 67,200. 69,120. And 69,120. Then from there, we need to compute the receipt from debtors. And these are basically the debtors who do not pay in cash. Receipt from debtors. Receipt from debtors. Receipt from debtors. Now, in this case, we are interested with the amount from which will be received from debtors in April, in May, and also in what? In June. Now, basically, those debtors who do not pay in cash are automatically 80%. 80% of the sales will not be paid in cash, rather will be paid in credit. Will be paid in what? In credit. And in this case, we are told that 70% of the debtors pay within 1 month, receiving 2% discount, while the remaining debtors pay after 2 months. So remember, in this case, the debtors who pay in cash are 20%. Are 20%. 20%. Just a minute. Okay, so let's continue. So in this case, what I was saying is that those particular debtors who pay in cash 20%. It basically means that those debtors who do not pay in cash will be equivalent to 80%. Will be equivalent to 80%. In this case, we are told there that 70% basically pay after 1 month. After 1 month, and then the others pay after 2 months. So in this case, they do not receive now any discount. So I think in this case here, let's start with the debtors who pay after 1 month, who pay after 1 month, of which those who pay after 1 month will be equal to 70%. Will be equal to 70% of the sales. 70% of this. So what we need to have here, because they pay after 1 month, this pay after 1 month. After 1 month, so we need here to have I think we need to have the sales before you put down that one. Let's have the sales, because we have even those who pay after 2 months. So let's have we have the sales which were made from Feb, March, April, May, and then we have June. We have those 4 months like that, and then we have now the sales. The sales which were made from Feb, as per the information we have at the note 1. So the sales here were 350. Here were 400. Here were in April 350,000. In May, they were what? They were 360. They were 360. Do we need to have the sales for June? Do we need to have the sales for June? No, we don't need to have the sales for June. So in this case, those who will pay after 1 month will be 70% of this. The ones who pay after 1 month, 70% of this. So, and in our case now, remember, our interest is basically to compute the amount which were received in this month. April, May, and what? And June. So meaning that 70% of the sales which were made in March will be paid for in April. So what will be 70% of this one? Is it 280? 280. And can we get that of discount? Or first of all, you can compute it like that. So method is 303. Yes, so I think in this case, we can in fact get that after discount. So we get 70%, and then the discount. The discount in this case is given as what? The discount which they will be receiving will be 2.5. 2.5. So meaning that they are going to pay an amount equal to 97.5. So these ones are paying after 1 month. Automatically, we take the sales which were made in March. We get 70% of that, and then times 97.5. 97.5. That will give us what? That will give us what? What is 70% of 400? I thought it's 280. Why are you getting 300? Oh, it is 440. Oh, sorry. So this one is 440, yeah? It is 440. Okay, it is 440. It is 440. Okay, 280, not 280, rather, 440 times 70% times the discount. Or we multiply that with 97.5. So that means that the amount now to be received here will be 300 like that. Okay, and then now this one will pay after 1 month. So we get 70% of 350. 70% of 350, what are you getting? And then times 97, which is coming to what? 238,875. And then those will pay in June, or 70% of the sales in May will be paid in June. So we get 70% of 360 and equally times 97.5%. What are you getting? 245,700. That's what you're getting, 245,700. Yes. So these are now the amount which will be paid after 1 month. And then we can compute those, the amount to be received after 2 months. In this case, remember, those will pay after 2 months automatically should be the difference, should be the balance. Remember, 20% paid in the same month, 70% paid after 1 month. So that is a total 90%. So the ones who will be paying after 2 months will be 10%. And in this case, no discount here. No discount, no discount. So meaning that the sales which were made in Feb, 10% of this, the amount will be received in May. Not in May, rather in April here. So what is 10% of this? 10% of that is 35,000, no discount. Then 10% of this will pay in this month, 10%, which is 44,000, and 10% of this will pay in June, 35,000. 35,000. And I think now we can add this. We can add the amount to be received from who? The amount to be received from debtors. The amount to be received from the debtors here. Compute for me here the amount to be received. So just add that and that. So this will give us 335, 300. What about this one? So it will give us 282, 875. What about this one? 28700. 28700. Is that what you're getting? Are those the figures you're getting? Those are the figures you're getting. 300, 282, 875 to 700. Yes, that's what you have taken, Maureen. So we are taking 10% this one. 10% of the sales. So 10% of the sales for Feb will be paid after 2 months. So 10% of this. 10% of this will be paid in May after 2 months. 44,000. 10% of this will be paid in June, or will be received in June. That's what we have taken. Or we have taken different figures. We have taken 10% of the sales. And those debtors who pay after 2 months, no discount, they are extended to them. No discount extended to them. Yes, so in our case, I think now we are done with computing that. I think what is remaining here, we have not dealt with the payment of materials. Payment of materials, we were given some information with respect to that. In note number 2, sorry. In note number 2, we are told the period for credit allowed by suppliers were average of 2 months. So basically what that means is that the suppliers of materials are paid after 2 months. And basically the suppliers of materials, we are given the materials to be purchased. So we can have now the payment to suppliers here. Payment to suppliers of raw materials. So the suppliers of raw materials are paid after 2 months. So meaning that the suppliers who are paid in April are the suppliers who supplied raw materials in which month? In the month of Feb. In the month of what? Feb. So the materials supplied in Feb, they had a value of 100,000. A value of 100,000. So the materials supplied in March, they'll be paid after 2 months. They'll be paid after 2 months. They'll be paid after 2 months. That is in May. The materials which were supplied in March will be paid in May. And the materials supplied in April will be paid in June after 2 months. Materials supplied in April, 90,000 like that. 90,000 like that. 90,000 like that. Oh, there is. Yes, 90,000 like that. So period of credit allowed for suppliers, average of 2 months. Yes, and I think in our case we are done. We have, I think, captured everything here. What is basically remaining is for us to be able to balance our cash, or not to balance, rather, we get the totals. We get the totals for the totals here. The totals, we get the totals so that now we can get the cash balances. So let's do that. Although this is now something you can be able to do on your own, I don't think we have to spend time on that, because this is majorly what is important. Yes, so in this case, what you just need to do here is to get the totals in the first month. Yes, so here you just get this total here, and then you come and you less now the total what, because here we should have the total receipt, including the opening cash balance, and then we also have the total what, the total payment. I don't think we have any problem with that. So add all this, record the total here, and then you add all this. You record the totals here, and then you get now the closing cash balance. The closing cash balance, of which the closing cash balance should be equal to the total amount there, A, minus what? Minus B. That is basically what we know. You take this minus whatever you have there, you get the closing cash balance, of which the closing cash balance here will be the opening in this month here. So you do the same. You add all this, you get the totals here. You add the payment here. You take this minus this, you get the closing cash balance, and that now will be the opening cash balance there. The opening cash what? The opening cash balance. The opening cash balance. Yes, I think that is something can be able now to finish. So no need of going to that extent. And actually what we said in these particular questions, what I'll mark are these entries here. These are the entries which give you the marks, which were located in that particular word question. So we said we come across that question here. Is basically a question which is very, very simple in relation to cash budget, in relation to cash budget. Yes, so that is it. That is those are basically the two questions I wanted us to revise. We revised on, and I think that now brings us now to the end of our revision. So I think now what is remaining is for you to be able to try and revise all the other topics. Make sure you revise on everything, because management accounting, the question can come from any of the topic, including the theories which you have discussed. Make sure you revise on all those areas, all those particular areas. I think maybe have tried to do the best we could with the limited time we had, because that semester was really short. But I think we have tried to do what we could be able to to do. So I think we stop at that point for today. Mine is just to wish you all the best as you sit for this paper, I think on Wednesday or Tuesday, and make sure you at least pass. You pass this paper, then coming next sitting, you'll be able to proceed to the next word, to the next level. But still, before maybe you sit for this paper, if you feel maybe there is a question which you have, maybe you can ask, you can write a message, and then I'll be able to do what? To address that. I don't know whether there is any question before, a general one, before we wind up. So that I can be able now to review, to be able to do the final touches. Any general question or maybe anything to be added? Maureen, what are you saying? Maureen, what are you saying? Industrial engineering, I think that was purely theoretical in nature. Purely theoretical in nature. There is nothing we did as far as that is concerned. We just need to be able to understand what is industrial engineering. There is no computation as far as that method of cost estimation we did. I think we say the only methods of cost estimation which involved computation was the count analysis method, the simple linear regression, or the least square method, and I think the other one which was the high-row method. I think those were some of the methods which had computation. Industrial engineering, you just need to be in a position to explain that. What is the meaning of industrial engineering? And I think, yes, some of the advantages, disadvantages associated with that particular method. No computation which involved as far as that method is what is concerned. Yes, so let's stop at that point. Wish you all the best as you do the final touches. Make sure you prepare well and you sit for this paper. You do what? You pass. At least we meet now in the next level as you'll be sitting now for the advanced all papers for the advanced paper. The last one under the payment. What are you asking here? Payment to suppliers. I think there was some information we were given in relation to that. Link on number 2. So there is somewhere we are told payments, suppliers of raw materials are out 2 months credit. So it automatically means that the suppliers of raw materials are paid after 2 months. So that's what it means, after 2 months. After 2 months. For example, now the amount paid to suppliers here are the materials which were purchased not in March, but the materials purchased in Feb. So that's what you're told? Yes, that's why you have taken this one. Sasa, after 2 months, Yes, let's stop at that point. All the best. But if you feel that you have any question, maybe just free to ask. All the best.